So hello, my beautiful, beautiful little monkeys. Um, if you can't tell in the background, everything is empty, everything's gone. That's because we're moving. I will be talking about that in a couple of months, but yeah, moving, so that's all, that's fun. Finally have the face cam back on, but for what everyone is here for, the trade reflection, the trading lesson today. We're finally getting to the point within our trading, fortunately, to where we understand what we are looking for. We understand the model we execute on, and we're starting to get it down. We're starting to get the model down. And by me creating these videos, explaining my case studies to you guys and sharing my case studies, I'm able to actually improve within my trading. So for anybody, or for thank you me for creating these videos. These videos are really just a way for me to increase my knowledge about my case studies and digest more information. But let's get into it. Today's case study is going to be paired with candle science. I'm sure 0% of you guys have probably heard about this, and if you have, you're probably already profitable. But let's break it down. Today's trade was a cool trade. We'll quickly reflect the trading day. You can see we have not traded at all whatsoever throughout the week. We've been very, very patient with our trading, which I've seen is a benefit a lot of the time. The old me would have thought, oh, not trading for 1, 2, 3, 4, 5, 6 days is too much. We need to force a trade. And I definitely would have resulted in me taking a loss in either Monday, Tuesday, or Wednesday because the market conditions were just so improbable. And how did I garner this understanding of proper market conditions? Of course, doing the case study, but the case study is subjective, really teaching me, explaining it to the camera, um, understanding what works, what doesn't, and going in and using that data, that newfound knowledge, to refine my trading in order to focus on staying away from improbable market conditions, emphasizing improbable market conditions, because I understood if I can understand what improbable market conditions are, it'll allow me to then focus and understand inversely when we are within probable market conditions. Of course, I did that whole case study. It may be linked below. I'm not sure. I may link the candle science one, but why not? I'll link that one. But let's go into my daily journal today. We can even check out a few from throughout the days. Obviously, for you guys that watch these, these are typically longer videos. That's because I like to fully explain my thought process and bring you guys along with me. By you guys, I mean the future me watching this video. Right here, we have our trading notes, trade images, everything of the sort. So let's get into it. When viewing this from a logical standpoint, this is what I wrote today. These market conditions have been horrible recently. Today we are continuing to make a push to the downside. This will be interesting. As of right now, we are only waiting to take a trade once we break out of the current range we are within. What is the current range we are within, Lonnie? Well, the current range we were within was on the hourly time frame. It was from this swing high to this swing low. I wanted to see a strong displacement out of this range. That would showcase that we are no longer within seek and destroy market conditions, and we're able to go in and execute normally within trending market conditions. Now, it would also showcase the beginning of the invalidation of this 1 hour and 4 hour PD array. How would we have known we were beginning to invalidate this? Because of candle science. How candles close allow us to get a full understanding on what the next few candles will do next. I'll get into that whole case study later. Now, if I go right here, scaling down in time frame, we also had a micro range. You can see right here, if you're able to notice it without me even plotting it out, congratulations, you're doing good. From this 5-minute swing high, 15-minute swing high, or even hourly swing high, to this swing low right here, which we failed to previously sweep out for liquidity. Yesterday, I was analyzing, trying to see if there may have been something we missed. On ES, there was a sell setup to the downside earlier where I was bearish. However, I knew it wasn't probable due to there being no specific draws on liquidity having been swept prior. So because we didn't sweep any draws on liquidity prior, the probability was already lowered. Doesn't mean it was fully ruled out, it just means it was lowered, right? You always have to take that into account. Now, continuing with everything that was going on, price action made that push to the downside. I originally was bearish. We will read right here. If we break it to the downside, this will begin to slightly show signs of a bearish push lower into the 4-hour fair value gap due to having a body close within the bullish PD array. We have showcased a 5-minute time frame market structure shift to the downside where there will most likely be a fair value gap forming. It is not this fair value gap we want to execute on, however, but instead the next one. What does Lonnie mean by this? Well, something cool we learned about fair value gaps recently, if you watch in one of our trade reflection videos throughout the presidential election week, we realized, how do you know when you're continuing to follow, very simply, how do you know when you're continuing to follow trend or your bias? Well, when you continue to validate and create new fair value gaps within that respected direction. So if we're bearish, we want to see more bearish fair value gaps get formed and validated, validating our bearish trade bias exactly here. So we've seen, okay, we have this, let me hide this, we have this new bearish fair value gap get formed right here. Cool. This new bearish fair value gap formed. Typically we would execute on this. Why didn't we execute on it? Because of these stop loss placements and the draws on liquidity. So I knew this. I'm like, you know what? I don't like the trade entry. I could, probabilistically speaking, if we are going to continue bearish, get double the confluence by seeing another PD array get formed, then looking to have that as my trade retracement. So right here, strong displacement to the downside, a new PD array gets formed. This would be my trade entry. Now you may be like, well, Lonnie, that happened. Why didn't you execute on that? Because upon forming that, we swept out liquidity. Upon forming that, we swept out liquidity. You can see right here, liquidity was swept. Okay, I recorded that entire segment, but we're going to re-record it. There was too much background noise. So upon seeing this liquidity get swept, that's when my bias switched to now being bullish. So it was that sweep that validated and shifted the probability beginning to stack up in bullish favor rather than bearish. Price action began to make the move to the upside and validating this bearish imbalance. Once we validated that bearish PD array, we've seen confluence that we would continue back to the upside. I liked what I seen on this 1 minute PD array get formed, this fair value gap. We executed upon it. We did make a slight push to the downside in validating it. Upon seeing that, I thought, okay, well, maybe my trade entry was too early, but I realized then we made the retracement for the equilibrium of this micro time frame range we formed. Once we validated this, we made a slight push to the upside, had our 5-minute time frame market structure shift back to the upside, and now once we hit our first trade target, which was right here at 1-to-1, we trailed our stop loss below this low right here. This was the most validating trailed low that we could have from here to now being here. So our risk is definitely managed on this trade position. It's not about hitting the take profit or hitting the stop loss. It's about the trade execution as a whole and how to be able to replicate these trade ideas. Now, let's break down the actual notes, because I think this is more important than anything I really could show you guys, and anything I really could study. It's the case studies of how I get to these trade ideas and how we will continue to refine and improve on these trade ideas, because that's the whole premise of it. Why did Lonnie execute when he said, okay, market conditions may be a little iffy? Why did he do what he did? That's the whole question. And if we could go in and we can understand how we can continue to replicate great trade entries, even during times where market conditions may be a little bit improbable, we'll be able to win. Actually, before I show you guys the notes, let's go out and weigh the probability on our favorite platform, Toy Theater. You can see right here, we already did it. So, higher time frame narrative real quick. Bam, bullish PD array. What do you see? Okay, we see rejection off of it. That could count as 2, just so we don't gotta put a bunch of 1. Okay, cool. Bullish PD array, we've been rejecting off of it for a few days. Scaling down to the 4 hour, failed to close. Remember what I said earlier about the displacement within that 4 hour fair value gap. We failed to do so. So, bam, 1. Let's go to the hourly time frame. Okay, hourly. Guess what? We swept out liquidity. That's heavy. That's a strong one. That's 2. That's very, that shows probability back to the upside. Now 15-minute. We did make a 15-minute retracement for this 15-minute PD array as well, validating it as well as sweeping out the accumulation on the micro time frame that was there. Okay, 2 again. Cool. We already acknowledged us sweeping out this accumulation. Cool. Now we had a sharp turn model or whatever you want to call it, market structure shift back to upside, blah, 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 blah. So, now you see we have some good probability back to the upside. But let's look at the inverse, probability to the downside. Why would we have continued lower? Why would Lonnie would have gotten stopped out? Oh, well, we could also put that last one. We began to validate. Actually, we'll put that as 2. We began to validate bullish PD arrays and invalidate bearish PD arrays. Cool. We have some solid probability if you ask me. So I'll remove these 2. I'll just put 4. I'll put 2 4s. Bam. Have some solid probability if you ask me. Now bearish. Why could have Lonnie gotten stopped out on this trade? Why may he get stopped out? X, Y, and Z, whatever the case is. Well, on the 4 hour time frame, we have been making a push to the downside. So that's definitely one. We've been showcasing a bearish push to the downside. Now on the hourly time frame, this may not look as appealing to trade, mainly because we are within a range, so we'll mark that as 2. Okay, cool. So we are within a range, and it's not a pretty range. However, this on the bullish side combats that because we swept out liquidity. You see what we're getting with this? Going to the 15-minute time frame. 15-minute, we had a market open retracement, then continuing to make that push to the downside. Okay, that's 1. Cool, we acknowledge that. What else? Now we had a strong displacement to the downside, validating bearish PD arrays. Now we can either put this as a 1 or 2. The reason I say 1 or 2 is because we began to invalidate these. So just for example, we'll put these as 2. So pair this as 6. If I can delete this, can I delete this? Okay, there you go. Now you see we're still within favor of bullish price action. Then what did we continue to do? Well, nothing. This was all of our bearish confluence. That was all we had. And you can see right here we have 6, right here we have 11. The probabilities outweigh each other. It's not that you won't face opposite, contrasting opinions. You will. You just have to realize which side showcases a greater argument. Whichever side showcases a greater argument, you take that reasoning and you work with it. We're not going to work with a bearish trade idea. When bullish probability showcases a better argument, then bearish is all about probability. And that's something I got confused. I would confuse the probability. I'd be like, whoa, I have a really good bullish trade idea right now, but there's bearish probability. That means it's not a good trade. No, that's not what it means. It's still a good trade idea. However, you just have to acknowledge that there is always going to be probability for you to lose a trade. There's still probability for me right now to lose a trade. Guess what? We could validate this bearish 5-minute imbalance, stop me out. Guess what? I put everything in my probability. Now this is where you're able to take control with the trade risk management on managing my risk. Okay, cool. I trailed my stop loss. Okay, I managed my risk on this day. I'm only taking 1 trade today, whatever the case is, right? You determine your risk factor. Final thing before we go into the mini lesson, and I'm just gonna skim through it. I'm not gonna fully break it down because it's a long video. Let's go over here, and for anybody that's curious, these are all the images. So now we can go back to full screening this, and we can go back to full screening this. This is how daily looked. Okay, this is how hourly looked. I don't like it when it says that. This is how hourly looks. So you can see all these images are in real time. Make it push to the downside. Once we saw that liquidity, 5-minute time frame market open. This is what I wrote. I will read that too. Bam. This, in simple terms, you could pause to read it. It was just saying how we're not going to execute on this fair value. Exactly what I told you guys. How we'd wait for the second PDO rate of form. 1-minute time frame. Images. Bam. 15. You guys get the point. You can pause and actually analyze if you want. But I do this in order to actually see how price action develops in real time upon my trade entry. Now, this cool image right here. Before I get into the last thing, what are the 5 key fundamentals of trading? We covered this last time. We have bias, number 1. We have our narrative as our drawn liquidity. We have our context, which is what allows us to garner an understanding before getting a trade idea. We have our trade entry, and then lastly, we have our risk management. I know I spelled management wrong. Risk management. These 5 key components create what we call the 5 fundamentals of trading. It starts from bias, narrative, context, entry, and risk management. This is universal between all trade strategies. Universal. So, I wanted to see, okay, well, how would this trade entry align within these 5 fundamentals? Well, how do we get our bias? Realize we didn't get our bias instantly, so we got our bias through sweeping out liquidity. We realized we were bullish. Bam, that's our bias. Where was our narrative? Well, our narrative currently is the, highs at market open, drawn liquidity, or the sweep, whatever you want to call it. Actual high on the day is somewhere around up here. Context area. Where was our context area on our sharp turn model? Call it whatever you want. The reversal of the liquidity sweep. Our entry was on the 1 minute fair value gap, and our risk management was risk managed. Right? Those are the 5 fundamentals. That's how we played into it perfectly within this trade. If you're missing one of these 5 fundamentals, that means you're missing something within your trading. We don't want that. That showcases a lack of probability. We want to be able to see and analyze these 5 probabilities, or well, not 5 probabilities, 5 key components to our trading. There you go. Now, trading. There you go. Now, let's minimize out. We're done with that. Candle signs. How can we use candle signs for our advantage? I am not done with this entire case study. There's a lot more to do with more images, including it, cleaning it up. I also have to include a whole nother videos, case studies into this one pertaining to candle signs. But you have to and remember is that every higher time frame candle has a lower time frame candles within it, forming PD arrays, fair value gaps. Every single higher time frame candle has a lower time frame story, a lower time frame narrative. We can read the lower time frame narrative simply by looking at the higher time frame candle. So by us closing on the 15-minute with a wick, what did this showcase to us? Well, it showcased we had a reversal right here. Well, how did this reversal look? Well, it looked something like this. Clearly, it had to have, or something like this, or simply like this. It showcased a liquidity sweep on the 15-minute time frame, whether we would have swept out this macro liquidity or not. Why? Because of candle science, how the candles close, the new candle opening high and lows. All of that can help us understand how the next few candlesticks will then develop. But it's simple to understand. I'm not done with the case study, so I won't link it in the description yet, but this was the full breakdown on today's trade idea, how we can go in and continue to improve. You could pause and read everything on the screen if you like. We do have our stop loss trail, but remember, it's not about the stop loss, it's not about the trade. I don't want to create these videos for you guys to emphasize the trade, because it's not about the trade. It's about everything that comes before the trade and everything that happens after the trade, the P&L, whether you hit a take profit, whether you hit a stop loss, whether you exit break even. It's not about that. And if that's what you're focusing on, it will reflect in your P&L. Remember, patience pays. Waiting for the right opportunities pays. Wait for the right opportunities. No matter how long it takes. You know what your probable market conditions are. Don't allow your opinion to be influenced by anybody else's. Make your own opinion by studying the charts, doing the case studies, and doing the work. It's boring, but at least we know it leads to something. So I love you guys. Thanks for watching, and peace.